Hello everyone, Professor Franz here, and today we're going to talk about the three tools of the Federal Reserves when it conducts monetary policy. Here are the three tools of the Fed: open market operations, also known as OMOs, discount rate, and the reserve requirement. We will start with the first tool, open market operations, OMOs. The definition of OMO is the buying and selling of government securities in the open market to change the money supply. And it is determined by the Federal Open Market Committee, also known as FOMC. If the Fed would like to increase money supply, then it will buy government bonds. If the Fed would like to decrease money supply, then it will sell government bonds. This tool is the most flexible and thus used most frequently. It can be hard to remember when does the Fed buy and sell bonds. So here is the intuition. If the Fed would like to increase money supply, it buys bonds. And by buying bonds, the Fed will have to pay you for the bonds. So the Fed will be injecting money into the banking system. By contrast, if the Fed would like to decrease money supply, it will sell bonds. So when the Fed is selling bonds, it is giving you the bond and takes away the money from the banking system, and as such, reduce our money supply. The second tool of the Fed is the discount rate. By definition, the discount rate is the interest rate at which banks can borrow money directly from the Federal Reserves. So if the Federal Reserves would like to increase money supply, then it should lower discount rate. Why is that? Because a lower discount rate will encourage the banks to borrow from the Fed and thus increase the money supply. By contrast, if the Federal Reserves would like to decrease money supply, then it should raise discount rate. Because the banks will see the discount rate is higher, they will not want to borrow from the Federal Reserves. As a result, money supply is going to go down. The third tool of the Fed is reserve requirement. By definition, reserve requirement is a fraction of checkable deposit that the bank must keep on hand as reserves, either in the form of cash or in the form of deposit at the Federal Reserve. If the Fed would like to increase money supply, then it will lower the reserve requirement. If the Fed would like to decrease money supply, then it will raise reserve requirement. Here is the intuition of reserve requirement. If we have a lower reserve requirement, that means for each deposit the bank takes, it can loan out a larger proportion of the money. And as such, money supply will go up. If we have a higher reserve requirement, that means for each deposit the bank takes, it can loan out a smaller proportion of the money. And as such, money supply will go down.